Welcome to Stock Talk with Nico Criticos. Today we're going to be doing an analyzation of Palantir stock, going over their latest earnings report, as well as doing a deep dive into a fundamental analysis of the company and if its stock price is at a healthy place. So we are going to use Nico's stock market checklist, something I've created to analyze the stock. But before we do so, I want to go through their earnings report and just point out a couple things. So the stock has been selling off a lot lately, okay? In the last 3 months, it's down over 51%. In the past year, it's down over 65%. And as you can see, my cost basis is at $18.73. So I'm down pretty big on this position. And if the reason why this happened lately is because it looks like so Palantir is a SaaS company that deals with, they pretty much use artificial intelligence, and they're a big data company. So they use this software to help companies and governments, make observations and do all that stuff that data does. But it looks like, so with their government, they have a government part of their business and they have a commercial business part of their business. And the commercial part that, gets businesses as their customers, that part is growing very fast. That's the strong part. The government part is not growing as fast. It's still growing healthy growth rates, but it's not meeting, it's not going to be the highlight of the show here. And that's what some investors were disappointed with. So if we look at total revenue for Q4, it grew 34% year over year to $433 million. The commercial revenue, how I said that's the faster growing one, that one grew 47% year over year. And for the United States part of the commercial revenue grew 132%. So that means internationally, they haven't, what I read was they have not invested into international markets as heavily as they have into United States markets. So that is why the US market is growing so much quicker. The government revenue grew 26%. So how I said, it's not as high as the commercial revenue, but 26% is still that's a healthy number. That's a respectable number. You could see in this latest quarter, they added 34 new net customers, and they closed 64 deals of $1 million or more. So that's the other good part about their business is it seems like it's a pretty sticky business model, and all the deals they do have with these companies are, long-term deals. They're big, expensive deals. They're worth 19 deals are worth over $10 million. So that's another strong part about their business model. Then if we look at the highlights for the full year of 2021, we can see total revenues grew 41%, very strong number they did $1.5 billion of revenue for the entire year. And once again, the United States revenue is growing faster than the international markets. And then you can see so commercial revenue grew 34%, but government revenue grew 47%. That's what's interesting here. So year over year, the government revenue actually grew more, but commercial revenue only grew 34%. The US commercial revenue though grew 100%. So that's really where they're excelling a lot at. The number of commercial customers they had tripled to 147 customers now. And so that's just saying, look at the United States commercial customer account increased from 4.7 times to 80 customers year over year. Then if we look at, this is their investor slide presentation, just pretty much goes over everything I just said. They missed, it looks like they missed earnings by a little bit. Where do we got it? Right there. So they were supposed to do 4 cents of EPS. They did 2 cents of EPS. Not a huge deal. They barely made a profit, but this is such a fast growing company. They're investing so much into marketing and to hiring people. And they said they're going to continually do that in 2022. They want to hire more people internationally. So I would expect, expenses to stay high and profitability to be in, not a great place for this year, but it's for the sake of growing the company. And we just want to see big revenue growth. We want to see revenue growth at least 30%. The other thing to watch out for with this one is the number of shares they've been issuing. So, it kind of goes hand in hand with hiring new talent to your team. But with every company, you always got to check out the share count. How many shares are they issuing? And for this company, if you look year over year, the number of shares change 116%. That's really bad. That's really, really, really bad. That means they're diluting shareholder value. And that's part of the reason why the stock is down 60% because those shares are worth less now. So that's a little bit of a problem. But quarter over quarter, it was only up a couple percent. So it's definitely getting better. But that's part of what goes into hiring new people is, giving them those stock options. And so you have to, that's something you have to expect. But that's also something to watch out for, because that's not very fair to investors if they're doing stuff where the number of shares is doubling within a year. That's not really fair, because that's going to cut the share price in half. So that's not too good, but that's something you got to deal with investing in a company like this that is growing so fast. Now, if we get into the checklist, we can see number one is this. Yes, the stock is down. It's down 60% in the past year. Revenue and net income, we have, once again, revenue has been growing super strong the past couple of years, so that's not a problem. But net income is not doing too good. Net income is not. I guess they have been. I guess their free cash flow is getting better. I guess you could say that, but they're still not reporting, profits quarter in, quarter out like a healthy company should be. So that's not one of their strengths. Next up, price to sales of 11. Okay, this is for the kind of on a forward basis for 2022, a forward price to sales of 11, and that's with 33% revenue growth. That's really good. Remember, my metric is you want revenue growth to be at least twice what the price to sales is, and in this case, it's almost triple. So I like that a lot, or it is triple. It is triple. Then you have price to earnings, and we have a price to earnings of 52. Once again, not cheap, definitely not cheap, but at the same time, with 62% growth, it's understandable. So you got to keep that in mind as well. And same thing with my EPS, with my price to earnings number. I like to think of the percent growth. I want it to be at least double what the price to earnings ratio is. So in this case, no, I'm sorry, that's not, no. Yeah, so if it was, it'd be at least half of what the price to earnings ratio was. So in this case, at a PE of 52, I want the company to be trading, doing at least 26% growth of EPS. They did 62%. So they're exceeding my expectations. Next up, is the company innovative? Do they have a moat? Yes, they definitely are innovative with the way they use their software for big data, and they have a moat because of the amount of partnerships they have with the governments and the companies now. I think it's also, you could also say a moat is how their business model is sticky. They're super expensive contracts that are going to last years. That could also be a moat. I think I would put, this is going to go in another category, but I would put their CEO, Alex Karp. I would include him. It looks like he's someone who is, different enough to where that kind of differentiates them. So that could be another thing. Next up, is it a growing industry? Yes. If you look, I looked up for the big data analytics market. It's expected to grow 13%. At an annual growth rate for the next 6 years. So definitely a good sign there. Return on invested capital, not good. This is a money losing company, so it's negative. Same thing with margins, negative. Cash flow, this one's interesting. This one I gave a yes, because as you can see here, operating cash flow getting better, right? Year after year, they did $222 million of positive operating cash flow. Okay. And cash position also growing very nicely, up to $2.4 billion now. That's good. And then free cash flow. Look at free cash flow. It's been negative, and just recently, now they're putting up strong free cash flow numbers. So that's going to get a check. Diverse revenue streams. Yes. How I said earlier, this pretty much just goes back to, how many customers they have, how many different ways do they make money, and in how many different countries do they operate. So we know they're expanding internationally. Okay. We know that they have tons of customers. They tripled their customer count in the last year. We know they have a commercial side of their business and the government side. So they're not just getting it from just one side. They have businesses and governments both to pay them. And what else do we have? We have, I guess the other thing would be for diverse revenue streams. There's something else I wanted to bring up, but if we look at the balance sheet, we could see assets are bigger than liabilities, so that's good. Equity of over $2 billion on a $20 billion company, that's strong, and equity is definitely increasing. Then strong share buyback, how I said they're having problems with that. No dividends, so I get a no. Big money and insiders are interested. Okay, if we go to the holders of this company, we know that it's well known that ARK is invested into this one, but you also have Vanguard and BlackRock with, you know, over $1 billion. So that's something. Insiders, I believe, let's see, 11% of shares are held by insiders. So that's fair. And then is it founder-led and good management? Yes. Alex Karp, the CEO, he's very well known for doing a good job of growing the company, and his, you know, he kind of, people think of him like as like an Albert Einstein almost. So yeah, I think that's a good thing as well. So overall, they get a score of 14 out of 18, and that is considered a buy. Now, if only I could think of what the other stream of revenue was. International markets, government and business sources of revenue, and then what was the other one? Their contracts, and they have big, their software has a big collection of data, right? And then yeah, I can't think of the other one, but that is my analysis on Palantir stock, and I do think it's I think it's at a fair price right now at $10 a share, and we'll see what happens, but I think this is going to be a strong one moving forward. So I will see you in the next video, and have a good day.